Good morning and welcome to the Daily Read. Before we get started today, let me tell you what exactly you're watching because it's different from most market shows. Every morning I run something called Regime Lab. It was an AI operating system that I created to get a feel for where the market was on any given day. I use it in my own trading so that I have an idea of where the direction is going. And the idea was simple. Instead of guessing where the market was headed, we score it. Same five things every single day, all from public data. One, which direction is the market moving? Two, how healthy that move is underneath the surface. Three, whether the credit market is calm or stressed. Four, what volatility is doing. And five, which sectors are actually leading. No hunches, no hype, just a scoreboard you can check. So here's what the scoreboard says today. So 2 Fridays in a row, the headlines scream tech sell off. Oh, everybody, the world is ending. And both times, the average stock in the S&P 500 actually rose. Then this weekend, the war news flipped, oil crashed, and futures took off. So what is it? Trouble or an all clear? Well, the scoreboard basically says neither. It's a rotation. What's happening is for 2 weeks now, the market's been rotating, not breaking down, money quietly moving out of a handful of giant tech names that led for 2 years and into everything else: financials, utilities, healthcare, industrials. Friday fit the pattern. The broad market was flat. The tech heavy Nasdaq, on the other hand, hit a new low, but the average stock was higher. Then the weekend changed the mood. The US and Iran paused the fighting. Oil tumbled 6 to 7%, and Monday morning stock futures jumped across the board. The Dow up about 1%, Nasdaq up more than that. So we opened the week with a brief bounce and a relief bounce on top of a market that was already changing leaders. And you don't have to take my word for it. Here's how the scoreboard reads. The direction: the broad S&P finished Friday basically flat, while the Nasdaq sits 3 to 5% below its trend lines. That's narrow weakness, not broad. The breadth, the equal weight S&P 500, the average stock, not the giants, actually rose about 0.75%. Credit and fear: the credit market stayed calm throughout this time period, and gold never caught a fear bid, and volatility eased. And the weekend tell, oil falling this hard on peace hopes actually takes pressure off inflation, off the Fed. Add it up, and you get the same verdict from every gauge. This is reallocation, not fear. So what does that mean for you? Mostly it's a reminder that the market and the Magnificent Seven are not the same thing. For years, owning a plain index fund quietly turned you into owning a big bet on a handful of tech giants. And most people never chose that purpose. Weeks like this are the nudge to look under the hood at what you actually own, not to panic, just to look and to know. So here's what makes this a big week. Two things land in the next few days that could confirm the story or break it. Wednesday, the Federal Reserve decides on interest rates. A hold is expected, but with this year's oil spike, a hike isn't fully off the table. And Wednesday and Thursday, the four biggest tech names report earnings. If credit stays calm through both, the rotation is healthy. If it cracks, the story changes. So that's your daily read. I'm Jeff Kickle with Exit Rich, Retire Free. This is for education, not investment advice. But if you'd like to talk through your own plan, you know where to find me.